Hello, you're watching One2 Tax. In the previous video, we briefly introduced what capital gains tax is. In this video, we are now going to look at how to calculate capital gains tax. To do so, let's look at a few important definitions first. So, in general terms, capital gains tax is triggered when you dispose of an asset and the proceeds that are received for that asset are not subject to income tax. That means that the proceeds received for the asset must be of a capital nature, because otherwise it would be included in your gross income and therefore subject to income tax already. The disposal of an asset, what that means is that you give up ownership of an asset, most commonly through a sale, but it could also happen through various other ways like a donation or inheritance or a few other examples as well. The proceeds is the amount that is received by or accrues to the taxpayer upon the disposal of an asset, although in some cases there may be deemed proceeds, like in a donation, then one deems the proceeds to be the market value of an asset. But we won't look into that in this course. Then the base cost is the amount including cost that was paid by the taxpayer to initially acquire the asset. And then the annual exclusion, what we mean when we're referring to that, is in the context of individuals. An individual has a 40,000 Rand annual exclusion for capital gains tax, which we'll explain a little bit later in this video. So to calculate capital gains tax, we're looking at a few formulas now. A capital gain is the proceeds minus the base cost. A net capital gain is the proceeds minus the base cost minus that 40,000 Rand annual exclusion in the context of individuals. And then your taxable capital gain, we take the net capital gain and we multiply it by 40%, which is called the inclusion rate. And that 40% is only applicable to natural persons. For a company, you would times it by 80%. So companies are taxed heavier on capital gains than individuals are. And then your taxable capital gain is that amount, and that is the amount that is included in your taxable income, just like any other income would be, or gross income would be. Then there are a few exclusions or exceptions. So important one is upon the disposal of a primary residence. So the house that you live in, if you sell that house, the first 2 million Rand in capital gains are tax-free. And then there are certain personal use assets, things like cars, furniture, art. Those are all exempt from capital gains tax, but there are other personal use assets like, for instance, a boat that is longer than 10 meters that will be subject to capital gains tax should you make a capital gain when you sell that asset. And then another exclusion applicable to individuals is when you sell a business, a small business, the first 1.8 million Rand in taxable capital gains are not taxable. So you are able to sell a small business to the value of 10 million Rand for a capital gain of 10 million Rand without having to pay capital gains tax. And then we've already looked at the annual exclusion. All individuals have a 40,000 Rand annual exclusion per year. And then in the year that you die, all your assets are going to, a disposal will occur in respect of all your assets, and for that reason you get a higher exclusion of 300,000 Rand in your year of death. So let's look at a simple example to illustrate how it works. Steph bought 5,000 Rands worth of Bitcoin in 2014, and she bought it as a capital asset. In August 2021, she sold it for 700,000 Rand. So what are the capital gains tax implications? Well, it's pretty straightforward. The base cost is 5,000 Rand. The proceeds is 700,000 Rand. that means that her capital gain is 695,000 Rand using the formulas we looked at a few slides ago. Her net capital gain is 655,000. We get that by subtracting her annual exclusion from her capital gain, and then to get her taxable capital gain, we multiply her net capital gain by 40%. And that is the amount that is then included in her taxable income. And it's as simple as that. So we're not going to go into the complexities of capital gains tax in this course, but this gives you a basic idea of what we mean when we refer to capital gains tax and also how to calculate it. And that brings this section to an end. In the next section, you will be taken through practical e-filing by Ashley.